Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. It's May 8th. What is today? Wednesday.
That's
1 o'clock on the East Coast. Today it's just Elizabeth and I, so that's either a very good thing for you folks or a very bad thing. You're the good witch or a bad witch. You were in the Wizard of Oz.
Glinda was the good witch.
You were in the Wizard of Oz.
I was Dorothy in the Wizard of Oz in 8th grade.
Yes. You sent me pictures, which I have not published because
Thank God.
But they're adorable.
Yeah, well.
Dan is still in California. Okay, let's just get that out of the way.
Okay.
It is market call. It's 1 o'clock. If you have questions, we will take questions.
Oh.
So I'm going to throw that out there.
Great.
So we have a rundown in a second. So before this show, Elizabeth and I, were chatting, and she said, when was the last time you were nervous?
He tried to pretend he was nervous before this show, which I knew
was not the case.
A crock of caca.
And I said, it was actually last night during the Ranger game. Now, she knew that the game went double overtime, but she didn't know if the Rangers won or lost, which I don't know what I find more. That just hurts me at a granular, soulful, molecular level. Yeah. Now, her friend Amanda, not our Amanda, although you're friends with our Amanda, your friend Amanda, who I have met, and I dig her. She's a badass. She's this little shit, but she's tough. She was all geeked up last night because you were at dinner. She's like, I got to get out of here and watch the game.
She couldn't get home fast enough to watch the rest of the game. And then it went to double overtime. That's how I know that, because I knew that she got home late to watch the game, but then she got to see a bunch of it because it went into double OT.
Yeah.
Now, we're talking about this. It's now been, I don't know,
a few minutes,
like 7 minutes. I still don't know if they won.
See, that's what's so upsetting to me. In today's world where you have access to everything, one would think that just out of natural curiosity, you would say, I wonder who won that double overtime game at Madison Square Garden. It's the Rangers, by the way. Anyhow, let's put up the rundown because there's a lot going on today. New S&P highs ahead. Well, a tweet from you suggests potentially that is the case. I love your Twitter account, by the way. Higher for longer impact on stocks. Uber and Shopify, disaster du jour. That means of the day. That's like soup du jour, soup of the day.
Yeah.
And you typically, it's funny. There are a few soups that I will have. Amanda, she's not in my ear. I don't have my IFB in, so
sorry,
I'm sure
Amanda,
she's just.
I'm
sorry as well, but French onion soup, which is typically not a du jour soup, but I will always get a Foss if it's on the menu. That's French onion soup.
Oh,
a good chicken noodle I will always do.
Really, from a restaurant?
Oh yeah, good. You know, like a good chicken noodle.
I mean, I love a good chicken noodle. I just feel like in a restaurant, it's a very basic thing that you could get for so much cheaper, like out of a can, and it's about the same. So you're going to pay this big upcharge for chicken noodle. Do
you want that?
If I'm going to pay for soup, make it good soup. Make it like clam chowder. Something I'm not going to do.
No.
Clam chowder.
No. Do you want that in the can? No, I'll take it right here. That's. And of course, if it's Wednesday, which is today, it's Butters. Typically, it's Thursday. It's Butters, but you are the perfect person to dissect Butters' work, and we will get into that.
Okay.
Anyhow, we talked about the market, and let's take a look at Elizabeth's tweet at Liz Young Strat. Throw this one up because this is there are a number of different ways to do to technical analysis, and one of the ways are these formations, and you have stars and doji stars and all these different fun little things. But your work suggests that, maybe we're on the precipice of, and we're not that far away as we sit here, taking out those prior all-time highs in the S&P, which I believe is 5264 or thereabouts. Thoughts?
Yeah. So, this is just purely technicals. And I think most of us know technicals are an input. They're not a full decision factor, but this is something that a lot of times can just tell you about the momentum. So obviously you can see on this chart, the recently deep drawdown, if you're just looking at it over a short-term period, it was a pretty quick drawdown. And then the market always usually has this sigh of relief after something like that, if there's not negative news to make that drawdown continue. It's not like a snowball rolling down a mountain. So we've had this nice little bounce. And then on top of that, we had the Fed last week tell us that they weren't perhaps going to hike rates. Everybody loved that as well, pushed that bounce even further up. And then you just have this situation where buying begets buying. And we've had a decent earnings season, at least in most of the tech stocks that we needed to come through in order to keep earnings positive. So there's been a culmination since about that April 22nd-ish timeframe of not so bad things that have happened, and the bullishness has come back. And if you look at actually futures positioning and speculative positioning, there's been a recent uptick in bullishness as well, which had been pretty bearish up until the last few weeks. So all this does is tell you, here's where the momentum is. Here's where if we're trading purely on algos, they're usually based on a lot of these technical levels. So we got back to that 50-day moving average, and then we retraced to 62-ish%. We could retrace up to the next level. So it just shows you the momentum of a market.
Of course, 61.8 being a Fibonacci retracement level.
Correct.
The great Italian mathematician. It's funny, throughout history, the greats tend to be Italians. I'm just saying.
Yeah.
You know, I can rattle off just a list of names.
Okay. Well,
you're not interested.
The gods tend to be Greeks.
The gods tend to be Greeks.
Yeah. I don't know if I'd like to be a great or a god. Which one?
It's interesting you say that. You know, I have to sort of think
I'm
of
neither,
that.
so it doesn't matter.
Well, what's funny is,
where do the Filipinos
I
fall?
love Melissa Lee. I do. And I have fun with people, and Amanda is losing her shit right now. But you know what? It's Wednesday. And I'll tell people, they'll come to the show a lot of times. I'm like, show's a lot of fun. I said, but be careful about Melissa. It's like looking into the eyes of Medusa. And they look at me like, I'm like, yeah, I'm just telling you, it's
Don't look her
don't look her directly in the
eyes.
eye. So in that
Mel,
regard, maybe it is
flack from him.
Anyhow, she does, but deservedly so to a certain extent. And we have fun together. And we enjoy each other's company. Let's look at our chart because you put up your chart with your fancy technicals. Here's ours suggesting exactly what you're just saying. So the purple line is the 50-day moving average. Obviously, the yellow, the 200-day moving average. Again, we haven't visited the 200-day since November of last year. I suggest the longer that we don't do that, the more, I don't even want to use the word dire, but the more likely it is to happen in a very precipitous fashion. So we breached the 50-day. The 50-day flattened out, okay? We traded down through it. We traded back up to it. And here we are through it to the upside again. But we'll see how this whole thing plays out. So there's this tug of war at the 50-day moving average, which makes a lot of sense. And I think suggestive of your work that if obviously the longer we stay above this, the more inclined technically, algorithmically, machine generatedly, we are to take out those prior highs we saw. I want to say it was in March-ish.
Yeah, well, and the other thing that people will do now that we're above the 50-day moving average is they'll look at that level as, if we get back down to it, will it serve as support? Will the market bounce off of that and stay above? In which case, momentum continues to the upside. So we are very near, and this was the point of my tweet too. We are very near those all-time highs, and given that we didn't have necessarily bad news or what the market would have interpreted as bad news from the Fed last week, and that momentum was sort of on its way already, we could get there pretty easily. Now, what does that mean? Does that mean that everything is fine? Does that mean that we shouldn't have any worries? No, but it's just a statement of fact in the technical universe that we're not that far off.
I want to be clear. I understand exactly what you're saying. I mean, price dictates, when I say, I want to be clear about this. When I say price is truth, I understand that, when you see moves of 15, 20%, through that lens, it doesn't make a lot of sense because clearly the day before the price was not truth. But I say that in the context of we take all these inputs, we look at all these different things, but at the end, what you base decisions off of is the price that the security, commodity, whatever it is trading at, because your decision making is much different at certain levels than it would be at other levels based on those same inputs. Anyhow, Susan Collins, which is another Fed official. There are a lot of them out there. I mean, it's like they talk a lot. They
talk every day.
And it's interesting because Stan Druckenmiller, and I'm trying to be very clear when I say that, because obviously if you put an N in the wrong place, it changes his name considerably. So Druckenmiller, who's a legend in our world, and he was on the Squawk Box the other day, and I'm paraphrasing completely, but he was saying these people are not rock stars. Somehow but they're out there, all these different constantly. Now, I don't know what's changed over the last 10 or 15 years, but these folks, in their own mind at least, have become somewhat celebrities. And she's out there saying that, oh, by the way, reaching that 2% inflation goal may take longer than we thought. Surprise. And listen, the market's not necessarily reacting to these things. However, they should start looking at, because we've talked about it for a while. Inflation is still a problem and it needs to be addressed. And I'll tell you is, for you folks wishing for rate cuts out there, I've said this and you said it to a certain extent. Be careful what you wish for, because quite frankly, if they can push these things out, the market might just sort of do the grind. If they cut, chances are it's because of reasons nobody is sort of foreseeing, and that typically is not supportive of the market.
One fun fact
I like
that
fun
I like
facts.
to point out, this isn't really a fun fact, but something that people should know about this, right? We're going to focus on this today. Susan Collins' comments made headlines today. She is not a voting member in 2024. Okay. Yes, maybe. I mean, her comments matter. Of course, she is in the room. They talk to her. Her inputs matter. She doesn't get a vote in 2024. The committee members rotate. So yes, all the committee members exist as members, but some of them, 5 of them to be exact, are alternates. So what's always fascinating to me is when the alternates make headlines and the markets move on the alternates. They're not even voting. They're not a dot on the dot plot. So be careful what you're also listening to, and be careful what you interpret as what you should do something about. Again, that's not to say that she doesn't matter. It's just that the way that the committee works, they don't all get to vote. So just putting that out there.
Very important. However, they all get to talk, right?
They do.
And that's clear. I mean, and that's obviously what's going on. And there is a tug of war. If you put up our 10-year yield chart, I mean, clearly there's a tug of war. And the speed with which we went from basically 4 3/4, a little bit shy of that, down to either side of 4.5, again, is startling to me. I want to be clear. I've thought for a while rates were going to go higher. I think you shared a similar view. Maybe it makes sense in the context of things being overbought or oversold, depending how you want to look at it. And this sort of back and fill, all it does is sort of take us down to what is a trend line, an upward trend line in terms of yields. I would agree with that. But my concern has been, the U.S. bond market should, again, be the most liquid, non-volatile instrument known to man, given the size of the economy, given the size of our bond market, yet it doesn't trade that way. So here we are. Look, the moving average is what it is. I think it comes in right around here-ish type of thing. A little bit low, I shouldn't say, probably 435. But thoughts on yields? Again, I want to be clear. You've brought up auctions coming up. There are going to be some pretty significant auctions coming up on the horizon. Particularly, I don't think they're going to go particularly well. We'll see how that plays out, which should make yields continue to go higher. Thoughts on the importance of this, which we talk about often, much, I'm sure, to the consternation of many.
Yeah. So the 10-year auction actually did cross the tape right as we started. We heard about the 10-year auction, and it came in pretty close to. So there's this sort of pre-sale. So they give a number to the yield that it might get. And then there's the actual sale, and a weak auction would be a case where the pre-sale yield was lower than the actual sale yield, meaning that once the auction actually went live to everybody, it garnered a lower price, a higher yield than was expected. That's been happening at a number of different tenors across the curve for a while, here and there, worse in some places than others. This week we have a 10-year auction. I believe we also have a 30-year auction. And the 10-year auction actually today came in pretty close to the pre-sale. So there wasn't much difference. I think many people expected it to be weaker than that. And you haven't seen yields move, for obvious reasons. You haven't seen yields move very much since that occurred because it came in sort of at expectations. But again, to back up, the question about why do we care about auctions, there are a number of different reasons why we care, but thinking about it from a big picture, with rates this high, the government's burden of debt and the government's burden of servicing that debt has risen quite a bit, which means that the deficit continues to grow. So the debt is rising just because rates are higher. The deficit continues to grow because we're behind. We did not budget for rates to be this high for this long. So we need people to pick up our treasuries in order to have money to meet obligations. That's also why it feels like we're having a conversation about a government shutdown once every 6 months or so. It hasn't really ever happened so far in this cycle to be something catastrophic, but we'll continue to hear about that because the the fact of the matter is money is tight at the government.
Money's tight, nothing's free. Won't somebody come and rescue me?
Okay.
Do you know what that is?
A song lyric, I'm going to guess.
Yes. That's an
Money
excellent
is
job
tight.
by you.
Money
I'm
is-
sure there are people out there in our viewing audience that know, of course, that's the great Stevie Ray Vaughan, who we lost way too soon. As a matter of fact, he was in your home state of Wisconsin on his way to another show where he lost his life.
Oh, well, that's sad.
That is sad.
Yeah.
You could look at me quizzically.
Sorry, Stevie.
You're not.
But, I
you
mean,
don't even know who
Wisconsin's a
Steve.
great- I mean, I know who he is. I
Okay.
definitely don't know that song.
One of the great guitar, one of the top 8 guitarists of all time.
Okay.
TLT chart real time, real quick to illustrate exactly what you're saying. It really hasn't moved all that much. So I think we're trading about 90.35. Typically, when you have these auctions that go either very well or very poorly, you'll see some significant movement. We have seen neither, which suggests it was somewhat benign. But again, I think the fireworks, if there are any, will come in the form of the longer dated auctions, which are coming to a theater near you, I believe. Now, as you know, I love you. Oh, before we get to that, because I do think this plays into it as well. Bank of Japan is flailing. That's my word. I'm not putting words in your. I would never do that. However, I think they realize what they're up against. And, 2 now interventions. One happened on a Sunday night when dollar yen went north of 160. I don't know if we can pull a real-time dollar yen chart up or not. And then again, so that first intervention took dollar yen to about 156. Subsequent intervention took it down to, I want to say, 153-ish. As we're sitting here today, though, the dollar once again is strengthening. The yen once again is weakening. And you can see it in this chart. If you want to go shorter duration, just to sort of illustrate exactly that. I only bring this up because they can try all they want with these interventions. And they'll work in the short term, maybe, but they ain't going to work in the long term. And again, that goes back to the conversation we just had about interest rates, bond auctions, and all those different things. People say, Guy, you focused. Nobody gives a shit about Japan. Oh, that was a nice, that's like a little song.
Yeah.
They should, is my point. You absolutely should, because all of these things, whether you like it or not, are interconnected. Quick thoughts on that.
So we talked about this, I believe, last week. They intervened, or maybe it was on OTT this week. They intervened by using what they had in the current account.
Correct.
Right? Just the cash.
It was our Monday show together.
That's just laying around, which most central banks have a certain amount of cash just sort of laying around. When I say cash, I mean dollars, right? So they dumped dollars in order to support the yen to make that trade-off change. And it did. It was effective 2 times. The yen did strengthen. The dollar did weaken as opposed to the yen. But here's the issue. They can't affect rates with that.
That's right.
Well, actually, there's 2 issues. The first issue is that they're going to run out of dollars to dump pretty quickly, in which case they have to find dollars from different sources, which is most likely to be their treasury holdings. They'll sell treasury holdings, get dollars for them, and then dump those dollars, right? So that
in an effort to support their weakening currency.
That's right. So that is all likely to come in headlines to a theater near you at some point, I would guess, in the next month or 2. The other issue here, though, is just generally speaking, this is like Econ 102, okay? Why is one currency stronger than another currency? Typically, because the stronger currency is offering investors higher rates. It's an interest rate differential. So we've got a Federal Reserve at 5.5%. We've got a 10-year treasury in the, 430s range. And we've got a Japanese 10-year. I'm trying to pull it up to get the exact quote. I want to say it's at like 0.8%.
I think it's,
something like that. So the interest rate differential is at 3.5%. Okay. So as any investor around the globe, if you are making a rational decision on where to get more interest, where to get a more attractive yield, you're still going to go to the US, which is why this isn't going to work long term. So the other option they have is they'll have to start raising rates, but they've got a long way to go. And the chances of them getting from where they are at 0.1 up to 5.5% to get their 10
No, that's not happening.
I mean, it would constrict their economy in a much different way, in my opinion. It would constrict their economy in a much different way than what has happened here. We have all been surprised by the strength of the US economy in the face of higher rates. I would venture to guess that Japan would not be nearly as resilient to such a rate rise, but that would be the last ditch effort at trying to support the yen and weakening the dollar. It's just that the gap is so wide they can't do that in one or two interventions.
They are, the lesser of two evils. If you go back to mythology, I believe it was mythology, the Straits of Messina, very narrow straits, which I think we may have chatted about. You know, the people found themselves with the decision to make, neither of which were particularly good in terms of the sailors trying to get through the Straits of Messina. Okay. And we'll put it in the show notes or not. I don't know. My point is, that's what they are faced with. And I think if they don't know they're screwed, that's a problem. If they know they're screwed, they're screwed. So either way, and again, you're being hyperbolic. I'm telling you, I'm not, because this has far-reaching effects. Yeah. Anyhow, you bring us charts, and as you know, have you gotten to know over the last few years, as we've gotten to know each other, which, by the way, has been one of the thrills of my life, and I mean that sincerely. I'm not the brightest bulb in the fixture. This chart,
a few French fries short of a Happy Meal, are you?
Yes. Now, interesting you say that, because I asked you what you got at McDonald's, and you got like one cheeseburger, which is lame, and a small fries, which is
viewers.
You know what? Just hold on a second, and you can retort. The people that work at McDonald's, I have not, but my sense is when people order small fries and they come in a little bag, they sort of laugh at you.
It's like an envelope of fries.
It's an envelope of
Usually
fries.
I visit McDonald's because I've got suddenly a craving for McDonald's. I don't want to go there and feel disgusting afterwards. I don't want to overindulge. I just need to like scratch the itch. And for me, one cheeseburger and a small fry scratches the itch.
Okay, fair enough.
Occasionally it's that 2 cheeseburger meal, and that's delicious.
Occasionally.
Occasionally. Occasionally. I think it's a number 7. Diaz knows. Anyway, so the chart. Are we going to my chart now?
Yeah, go to your chart. Change in personal interest income versus expense. This, look, I think I understand what this means. I don't think it portends anything particularly good, but please.
No. So I also got to tell you, and I said this to Mario this morning, I said, I really like this column. I think we did a good job on this note. I like the takeaways. This is data I hadn't seen yet. So the reason we wrote about this week is because there's been this debate that has bubbled up over the last couple of weeks where people have said higher rates are stimulative for the economy. Yeah. Of course, nothing's coming down because higher rates are stimulating. And the takeaway from that debate for them thinking that they're stimulative is that, well, there's more interest income. People can sit in risk-free assets, money market funds, treasuries, CDs, you name it, high yield savings accounts, and get 5% by taking no risk at all. I totally get that. That is fair. To suggest that it's stimulative because it's providing more money for people to spend, I thought, you know what? Let's find out. Is that actually the case? Is that possible? So the way that we chose to do this with the data was to take personal interest income, so what you get from those instruments that I just mentioned, and personal interest expense. And then we charted the change in each. So if this was actually stimulative, and there are a number of different ways you can
measure this. There'd be no red on the bottom.
There'd be no red on the bottom. Interest income is rising, sure.
Should make sense.
Interest expense is rising
faster.
Right. So hence where we are. And FYI, we went to the red at the end of 2022. All of 2023, this was negative. It's still negative now. The latest data is the first quarter of 2024. So this doesn't show us that it's stimulative to the economy. It's not providing consumers with more money to spend. And if we go to the next chart.
This is the one. So if you don't understand that chart, this should be the one like, oh, now I sort of get it. Because listen, mortgage, it makes sense. I mean, rates go higher. Mortgage expense makes that sort of logical.
Totally.
But the hockey stick of the blue line, the non-mortgage expense, and this speaks to something that I've talked about. People are combating inflation with basically credit and all those things. But anyway, please.
Yeah. So this is not even just about the rate of rise in each of these. It's also about the proportion. It's not shown in this chart, but I mentioned it in the text in the note. The proportion of interest expense. Everybody's got their interest expense, but then how much of your interest expense is going to your mortgage versus how much of it is going somewhere else? On average, since the 70s, that had been somewhere, let's call it in the 55 to 70% range going to a mortgage. Okay. Now, this is my personal opinion. I think consumer leverage is perfectly okay when you are using it to finance an asset that is gaining in value.
Fair.
You're using it in order to provide yourself with more buying power for an asset that can actually gain in value and become an equity producing asset.
A home, for example.
A home, for example. In which case, for a very long period of time, most Americans were spending much more on their mortgage interest than they were on other interest. What's happened since the pandemic is that, like you said, there's this hockey stick rise in the blue line, which is non-mortgage interest expense. So think about all the other consumer loans. We've got credit cards, auto loans, personal loans, all the things in there.
Education,
loans,
throw it out there.
Everything. Now, on some level, mathematically, this might make sense because you'll say to me, well, mortgage rates, although higher than they were, are always lower than the rates on those other loans, right? Credit card rates are 20-ish%. Auto loans, probably somewhere between 8 and 12, depending on credit, right? So yes, that's true. That is absolutely true. However, the rebuttal to that is the amount that you borrow in a mortgage is exponentially larger than what you would borrow in a personal loan, an auto loan, a credit card. So the fact that this blue line has gone up so rapidly shows that consumers are still burdened by the interest expense, but now they're burdened by it in what is more risky debt.
Yes.
Right. And that's the issue. And then people say, well, why is it risky? It's risky because in a mortgage, if you start to get behind on your mortgage, you can't do it. You sell the house. You've got collateral that then covers a decent portion of the loan, hopefully, and it's at a lower rate as it is, right? A lot of the other debt, consumer debt, is unsecured. What are you selling to cover it? What are you selling to cover credit card debt? What are you selling to cover a personal loan? What do you sell it? If you have a car is a depreciating asset, right? So, and that's sort of the gloomy look at it. Now, I also took the other side of the argument.
Because that's what you do.
Well, because it's fair. The other side of the argument is that consumer debt does increase when the economy is healthy. Usually you've got banks that are lending more fluidly. The flow of capital is working as it should between banks and between consumers. So usually they do take out more debt. Typically rates are lower when they're doing that. Rates are lower to encourage such taking out of debt. But it doesn't always mean that borrowing rising is a bad thing. So that's where this is not such a cut and dry argument. But my piece of it, my take on it is that the fact that all of this other debt is rising so much faster than mortgages, and because that previous chart shows that we are in the red, so to speak, where interest income is not outpacing interest expense, would tell me that this is probably not the healthiest type of borrowing that's going on. The last thing I'll say about this, sorry.
No, you know what? It's really important. It's fascinating because you're looking at both the potential outcome of both, and you're trying to be straight down the middle. So, I mean, my bias suggests this is not good, but as you point out, I mean, maybe not as bad as I think.
But here's the thing. It hasn't stopped people from spending. They're still spending.
Because they have, I'm stopped for 1 second. Because that's how they're combating inflation. They have no effing choice.
Right.
And so when I hear the bank CEOs and they talk about the health of the consumer vis-a-vis the spend they see, the spend is healthy. The reasons behind it is not. And that's not nuanced or me trying to be whatever. I mean, that's just almost factually true. Anyway.
Right. And because they haven't stopped spending, the other thing is when you're a retailer or a service provider, all you see is that the money came in. Somebody paid for their service. They paid for their goods. You don't know where it came from. I don't know if it came from their money market interest. I'm going to guess that it didn't. But you don't know if it came off of a credit card. You don't know if it came off cash that they had in savings, or maybe their income went up. But this is showing you that it's not all cash, right? It's not all coming from cash. It is coming from borrowing. The interest expense is rising. So then the question is, what's the tipping point? When is borrowing then a bad thing for the economy versus a good thing that's actually stimulating and creating more spending? It's a bad thing when some consumers, and we know that there are some out there who might be entering this danger zone or have already gotten into the danger zone, when they can't service their debt anymore. And then as that interest expense piles up, the interest expense just gets compounded onto the already outstanding debt. And then it's growing and growing and growing. And that's where the rule of compounding is a bad thing. And we're working backwards.
What is the title of you have a title, a working title?
It's not working. It's final.
Oh,
well, it's Liz looks at rate effects, and then the title is "The Higher the Better?" Question mark.
Yeah, and that's what we're talking about here.
It's all higher.
By the way, my God, Amanda's in my head. I was just about to say,
trying to get us to move on.
I know, she's mortified
today.
By the way, it's a tic-tac-toe board, as I brought up a number of times. I challenge anybody at some point. Maybe you and I will do it live one day. We'll do it up on this screen. We'll play tic-tac-toe. The rules are this. Thus, I go first.
Okay.
All you have to do to emerge victorious is to tie, just to basically create a draw.
Nobody wins.
A draw wins for you under those circumstances. So if I go first, that's an advantage. But if you draw, you win. Okay?
All right.
So anyway, sign up for
I'll take those odds.
If you say that now, Weisenheimer, sign up for Liz's block. Why wouldn't you? Uber reported, and I know we're not doing single stocks with you. I mentioned, and I've been talking. By the way, this is not in an effing vacuum. Okay, I brought this up a couple of weeks. I just want you to know this. Okay, we have the Instagram thing. We have an Instagram account.
Okay,
the kids call it the gram, I believe.
Right.
And when I was younger, the gram had a much different meaning. I won't get into that. By the way, when I was younger, Otto Graham played quarterback. You may remember him in your textbooks.
No.
But I said, listen, Uber is now the second largest holding in the transports, the IYT. I said, I don't have a real axe to grind with Uber. I said, however, you better watch it when they report because A, it's an important stock without question. It speaks to a lot of different things. But B, more importantly, in my opinion, what is it going to do to the IYT? So throw up an Uber chart real quick. You'll see we basically traded down to the 200-day moving-ish. We're getting close. I still think there's probably some room. We will see. It has been rolling over. By the way, it had a huge run to the upside and probably to a large extent justifiably so, but I think you're starting to see some cracks. Okay, pull up a transport chart because this is the one that I think is important. Now, this is a static one we're going to take a look at. I bring it up because it shows you the weighting of the U's, I say. Union Pacific, the number one weighted stock, followed by Uber, followed by United Parcel Service. Obviously, that's UPS. The three U's. Further down on that list is United Airlines. So it actually is 4 U's. Now, that's the chart. Amanda, do a longer-term real-time chart, and you will see what is a very significant – look at that. So if Amanda in real time can draw the line across those tops, you will see that the potential here for this double top formation that we talked about, it is real. So this is coming to, again, we talked about theater near you. We did a lot of, coming to you. Well, this is coming to you. Now, people say, you know what, Guy, you're a Johnson, which is true. The transports are not important. This is a much different economy. It's not 1930s,
right.
I get it.
Yes,
okay, I understand.
Yes. But
however,
Uber is 16% of the transports.
That's a flawed. I don't make. By the way, don't look at me like that. I don't make the effing ETF. Okay,
no,
I just saying, report
but
upon.
If that's the rebuttal that this is a new economy, it's not about the transports. Well, Uber is a part of the new economy.
You know what? Look at you. You're actually backing me up here. I like that. So anyway, I bring this up because I do think transports are still important. They've had a decent run, but you're right up against prior highs. So just keep that in mind as well. I just like to bring these things up because it's easy to be all flowery all the time and everything's beautiful, la, la, la. I'm not that person, as you've gotten to know.
And this is a philosophical debate that we shouldn't get into right now.
Go ahead. We got time.
Anyway. Here's the thing. If transports, I understand transports maybe are different than they were back in the day when everything was transported by rail and we didn't have any other options and, steam locomotives, all fine. Okay. It's different than that. We don't have a machine-based economy as much anymore. But you still have to buy the stuff, okay? You still go on to Amazon and you buy the stuff, right? How does the stuff get to you?
Exactly.
It's still has to be transported.
We haven't George Jetson this shit yet. Like it doesn't just magically like Star Trek, which I've never seen, just like vaporize into your living room.
Right.
Somebody is still driving that somehow.
Right.
They're still, no matter how advanced you want to think, if you drive out to whatever, you still see railroad tracks. You still see these trains that are mile friggin' long, bringing shit across the country. You still see truckers out there.
Right. And
to your point,
it has to have. I mean, I know they fly stuff too.
They fly stuff too.
But like, it's still, the stuff still has to move. The stuff still has to change hands. And as long as people are buying the stuff, they're going to move the stuff. If you buy less stuff, they're going to move less stuff. Like, so the transports still matter, even if we just buy it differently.
You know what also matters? Watch. I'm so good at this. Well, maybe not. I don't know. Valuation matters. And you say, okay, Shopify. Look at this sucker. Now, this is, again, everybody's darling. People like the name. It's clever. I get it. This stock down almost 20% on weak guidance. Now, was it weak enough for 20%? Probably. Well, again, price is truth, right? It's not necessarily that. It's the valuation that these companies trade at. So put up a longer-term Shopify chart. And again, when interest rates didn't matter to anybody, I mean, everybody loved this stock. And you'll see this in a non-static way, what I'm talking about. Now, when obviously interest rates are higher and valuation matters, you start to see what's going on here. So I keep this, again, you're seeing anecdotally these one-offs, but over and over again, you're seeing these, and they're not just small names. I mean, Shopify is a pretty significant company. You obviously saw similar in the name to the magnitude of a Facebook as well. So again, we're in a different paradigm right now. So just be aware.
Speaking of Shopify, I'm going to guess that the Shopify customer skews younger. Okay. One of the reasons that Mario and I wrote the column about what we did this week is because there was an article on Tuesday morning in the Wall Street Journal. I read it actually right before I went on Squawk, which was right after Stanley Druckenmiller.
Did you meet Stan?
I didn't.
Oh,
I wished that I did, but we were both there. I don't know how he snuck away without. Anyway, there was an article in the Wall Street Journal. You guys can look it up. I don't remember exactly what the headline says, but something about Gen Z falling further into debt or something along those lines. And here are some of the stats within. And this is why this is much more of a longer term demographic effect. But here's what's happening. You've got Gen Z graduating from college right now. In 2020, the average college graduate was earning about $59,000 a year. Okay. Fast forward to now, they're earning $60,000 a year. Look at, well, you guys are good. Look at that. That's the one.
That's the one. Incredible.
Go read it. People should go read that. So the income was $59,000 in 2020. It's now $60,000. So they have gone up by $1,000 over that period. Their average credit card bill is about $2,800 a month. They're carrying a balance. Okay.
At 22%.
Correct. So think about the math of this. Their income has gone up $1,000. These are young professionals just out of college. They're renting, obviously not buying a new house, but rent has gone up 22%. Okay. Their income's gone up $1,000. Rent is up 22%. And they're in a world of hurt. So they're building up credit card debt. They're probably asking parents for help.
Sure.
And now if you just ask them, well, what are your plans? They're delaying their plans. They're delaying life moves like buying a house, getting married, because when am I going to get out of this hole? Right. So why does this matter? I mean, it kind of sounds anecdotal. Obviously, Gen Z is not going to be what takes down our economy. They're not a big enough spending proportion, but they are the next gen of spending.
Yeah.
And you have to believe that if consumer spending is going to stay robust, you need Gen Z to do that household formation thing where they buy houses and they buy furniture and then they buy cars, because otherwise, where does it come from?
We'll do a whole show on demographics and all the things you just talked about. But what you're talking about is a potential generation that's not going to be able to do what past generation. And again, they're not buying shit just to have fun. I'm sure a lot of people do. A lot of times just buying things just to friggin' survive, get some food, right? Gasoline, all those different things. It's a fascinating, it's a great article. And Amanda or Jacob, whoever did that, I mean, that's just unbelievable.
Wizards back there.
Typically, if it's Thursday, can you say it, please?
Thursday is Butters Day.
So say if it's Thursday.
If it's Thursday,
it's
Butters.
Bitch. Yes, thank you. I mean, the fact that I had to really prompt you to get there, but at least
I've never had to do it before.
Well, next time.
If anybody doesn't believe us that we don't rehearse,
yeah, well, now you know.
Proof.
But you can't tell. But we're doing it today because the fact that you're here, again, so let's pull up Butters' work. By the way, John Butters, and I have to say this, the senior, what is it? The senior earnings analyst at FactSet.
Okay. That sounds right.
By the way, we were at FactSet conference. You were kind enough to go down.
I was there.
We got there on a Monday night. We left on a Thursday morning.
Yeah.
People were saying, like, Butters, the name Butters was like, you could feel it in the air, but he wasn't there. It was like, as I said at that day, it was like a Dickens apparition. Like you could feel him, but he wasn't there. That's how big John Butters is. Okay. He's so big that they didn't want him there because he would have sucked out all the oxygen in the room. Anyhow, earnings insight. Now, this is interesting. And I'm going to go back and I got to do some work on this because I am shocked at this. Bristol Myers, that comes out BMY, is the largest attractor to earnings growth for the S&P 500 in quarter one. That's factually probably 100% true. However, the fact that BMY can have this type of effect on the blended growth rate for the S&P, that is a staggering number, that BMY is big enough to be able to do that. With that said, okay, even if you back out Bristol Myers, is 8.3, basically 8.3% earnings growth. This is my question to you. Is it enough?
Is it enough?
Is it enough?
On the
Is it enough to
S&P?
keep things just sort of grinding along?
Sure. Yeah, 8.3 is enough. I think 8.3
Well,
is enough.
Vis-a-vis expectations of, okay, I'll change the question. In the context of expectations and where people think this year is going to,
Yeah.
is it on the way to, or, I guess what I'm saying is, like, should we be looking this through a critical eye? And I'm basically, again, I'm backing out BMY, or is there something more to this that sort of captures your fancy?
Given the fact that Q1 was never expected to be all that positive, it was, even before this, expected in the low single digits, I think somewhere between 0 and 5%. So even if we add BMY in and use the detraction, it's still above 5%, which is above expectations. 8.3 would be considerably above expectations for Q1. Now, the full year, we're still expecting 10-ish%, with the fourth quarter being the big whammy in that and pulling in, I don't remember exactly, somewhere in the teens, the mid-teens, I think, 14, 15%, something like that, earnings growth. So 8.3 would be a good step in that direction, still below what we're expecting for the full year. My usual concern is that when we're banking on the forward stuff to take care of it, right? So look, everything is okay now, but it'll get better later. That sort of kick the can down the road and expect better things in the future for not all that great of reasons. And there's no guarantee that that's going to occur. That's when you have to get nervous about valuations, because valuations today should reflect what's going to happen in the future. And if valuations today reflect double-digit teen earnings growth in the fourth quarter and something along the lines of 10 to 12 earnings growth for the year, then we have to make sure that that's actually going to occur. By the way, I did some quick research. Bristol Myers Squibb is, at least according to this ETF, number 99 on the list of weightings in the S&P. So the fact that it has this big of an influence is fascinating.
Do you know who Agent 99 was?
No. Where do you come up with this stuff?
Of course, that was the great Get Smart. That was a great, you don't remember Get Smart?
I've heard of it. Yeah.
Okay, you're so want to get out of here. Guy, how can we get John Butters' work? How can we join a community?
Yeah, how can we?
Well, that's how. I mean, first of all, I would say a lion's share of the people here do already. But if there's some newbies here, this is how you do it. Because I will tell you, you should get Butters' work, as you should get your work in your inbox. You should also get John Butters' work. Quickly, a couple questions, because I promised. Wavy McFly. And my sense is when he was born, or she was born.
One of our Twitter people?
Yeah.
Oh, yeah.
His mom and or dad didn't say, he looks like a Wavy to me. So this is probably just a clever.
Mom or dad also didn't.
But here's the question.
The last name.
Yeah. Well, you recall McFly was the name in those movies with Michael J. Fox.
Yes,
Back to the Future.
That I do recall.
McFly.
Yeah.
So he's Wavy McFly.
Okay.
Guy, explain how gold can go up, but GLT can go down.
Oh.
I love this. Love this question. I love this question. I have said to you over the years, and I've said to people, I cannot wax poetic about the construct of the GLD ETF. But what I will tell you is, and this is what I will say, there is a scenario where if I'm right about all the things that are happening, gold, the actual physical metal, and the miners can do extraordinarily well, while GLD could actually go down. And you're going to be like, you're out of your friggin' mind. Well, yes, that is true. But GLD, again, my opinion, is not it's not an ETF that is constructed for the reasons people want to own gold. In other words, when the shit really hits the fan, it's not GLD you want to be in. And Danny Moses and I talk about this. It's probably more PHYS, which is the Sprott physical gold ETF. So again, maybe we'll do a tutorial on that one day, but I just wanted to sort of throw that out. Disney. This is from Scott Rogers. Scott's here all the time. That's actually a name that probably his name.
Yeah,
right.
I would agree.
Remember Wayne Rogers or no?
It sounds familiar.
Okay, you just
these pop quizzes.
Just can I tell you something? Elizabeth wants to. You have like your shoes on.
You gotta
like
send me some kind of
That's not how my
document that I
mind
can
works.
read ahead of
That's
time
not how
so
my
I can
mind
be ready
works.
for these. Okay.
Wayne Rogers was the actor in the first 3 seasons of MASH. He
Okay.
played Trapper John.
Oh.
That's Wayne
Yeah.
Rogers.
If my
No?
mom is watching, she knows exactly
Your
what I'm talking
mom.
about.
Do you think she's
Yeah.
watching?
Not live, but she'll.
Oh, well,
I'll,
hi.
I'll tell her about it
Well,
later.
please.
Hi, Jamie.
Disney. Now, if you watched Market Call yesterday, which you didn't, I said, look, I'm hard pressed to understand a circumstance where they're going to report, given the run that the stock has had, and we're going to be trading, north of 125. I said, more likely scenario is they no longer can use price cuts and cost cutting as their way to prosperity. The market's given them that pass. Now they have to sort of prove themselves. And that actually one of the few times I've been right. Here is your now levels. And I said last night on CNBC's Fast Money, I think you're going to fill that gap, which was created last earnings, and it comes in around 98, Scott. So I hope that happens. If we get to 70, which is one of the parts of your question, I don't know. That suggests something really bad is going on, but we'll see. And my sense is if that were to happen, Nelson Peltz, who is getting up in years, is going to be ripshit pissed off.
Didn't they raise prices of tickets to theme parks?
I believe, yeah,
that was one
that's helpful.
But it was
When in a strapped situation, you're just making people more stressed. They have, I don't want to say they have problems that they have to address. And the problems that they need to address are not quick. I mean, these are things that are take, I think, years to figure out. Now, as you know, the market is a discounting mechanism, and this run we've seen over the last days, notwithstanding, this move lower left, upper right, suggests the market says, you know what, they can figure it out, and we're going to get ahead of this. But they're going to be what today's moves suggest to me, at least, they're going to be some hiccups along the way. What else is out there? Wavy McFly. Want one more?
Yeah.
JS. Now, this is somebody that doesn't want to give.
Oh, JS is. I thought it was a ticker
his or
symbol.
her surname,
Okay.
which is
Hi,
fine. I mean,
JS. We can make one up.
what was that DXY dip to 105? A fake out and going back up, interest rates too. Okay, so there you go. I get it. And we've talked about the dollar. We talked about rates. So obviously with rates going higher, the dollar was sort of going higher as well. The DXY, again, I think it's 60% euro-ish or so. I can't speak all that intelligently. However, as rates had that dramatic move lower, you saw a similar move in the dollar. To answer your question specifically, yes, I think it's a bit of a fake out to the downside. I think the trajectory of the dollar will probably continue to go higher until something breaks, but more because I think rates are going higher. So this is more a rate call to me, Elizabeth, than a dollar call.
Well, and that's how it should work. We talked about it before, right? Econ 102 is you got to look at the interest rate differentials and just.
Did you sit up front in economics?
I didn't ever really sit up front, but I was an engaged student. Yeah. But I mean, even, if you guys had a terminal to look at, I'm staring at it right now. If you had a screen to look at that showed you the yield on 10 years around the world, the United States at 4.48, Canada not far behind at 3.6, Brazil is above us, Mexico's above us. I mean, there are some options out there. There are options out there for getting a decent amount of interest. You've got the UK at 4.13, right? So they're not all Japan. Japan does sit at 0.87%, where the differential is just huge. But some of the currency moves that you'll see, depending on, to Guy's point, what it's tied to. Now, the DXY, as everybody knows, currencies are always a relative game. It's the US dollar versus another currency. This is aggregating a number of different ones. So it's going to be outsized effect by some of the bigger weights in that particular aggregation.
I've been to Brazil twice because you mentioned it.
Huh.
I'll tell a Brazil story maybe when we have more time.
Oh, okay.
No, because I have some good Brazil stories.
It's like one of those a cliffhanger.
I actually went to the top of the Corcovado. That's the Christ statue.
Oh,
it's one of those things that everybody.
Yeah.
If you have the whatever to do, I went for work, so I'm not putting that. You should go. It's one of those
do you
things
climb
in
steps,
life.
or how do you? Is it?
You can climb it, you can walk it, or you could take one of those cable car type thing, or you
Okay.
could get some Johnson to drive you, and then
For
walk
work,
back down.
You did this? Where
Yes,
were you working?
because I was working at the time, I believe, at Drexel Burnham Lambert, and the Central Bank of Brazil was a large client.
Oh,
I'll go into this is a fascinating story.
okay.
No?
Okay. I mean, yeah, I'm here. I'm here for
Yeah,
it.
but
I was just trying to figure out how
we're running out
religious
of we're
outing
running
turned
out of
into
time.
A work thing.
There's also, I think you said something about, basically a dollar versus something else.
Yeah. It's a relative game. Currency is a relative game.
As is the NBA.
Right.
Somebody wins and somebody loses.
That's
and
right.
tonight,
it's called a zero-sum game.
it is. Tonight, the Knickerbockers of New York
Uh-huh.
will be playing the Pacers of Indiana in game 2 of their second round series.
The Pacers took my Bucks out.
Excuse me?
The Pacers took my Bucks
Oh, your
out.
Milwaukee Bucks.
Yeah.
Oh,
Yeah.
yeah, they did.
So this is where I always get conflicted. Do you cheer for the team
you
that
do.
beat your team?
You know why? Because then in your mind, you can justify it.
Right.
Because if they win again, you say, well, I guess they're better than I thought. But if the team that just beat your team then gets swept in the next series, you already feel like shit, then you really feel like shit. Does that make sense?
It does. But now I feel like I'm going to be rooting against the Knickerbockers.
Because of that.
Right.
So you're
I'm
conflicted.
conflicted. You know what? I'll be happy. Whoever wins, I'll be happy. That's a very relaxing way to
No.
watch
You know
a
what that
game.
is? That's a very Midwest thing. I will not be happy with that with either outcome.
Okay.
There's a binary outcome. One makes me happy, one does not. But I'm not from the Midwest. I would have not done well in the Midwest, is my sense. Or maybe being born there, I would have never known the difference.
Yeah.
Does that make sense?
Fair. I think that's fair. You would have been molded in a different way, which is like a whole nature versus nurture and a different show.
So I don't know. Amanda's
start a therapy
she's
show.
at her wit's end.
Yep.
Which means we are at our end. But I enjoyed this immeasurably. Dan might be watching. I'm sure he's shaking his head. You and I can do this all day long.
This for 2 more hours.
But we won't. We'll spare you. I'll be here tomorrow with Carter Braxton Worth of Worth Charting.
Good. Yeah.
Where can we see you the rest of the week on? Will you be on?
I will be on the halftime report tomorrow.
HTR.
Yep.
Do you know who you'll be there with?
Downtown Josh Brown.
The TRB.
And Jim Leventhal, I believe.
Farmer Jim.
Yeah.
That's
Farmer
a good.
Jim and Downtown Josh Brown and me.
I hope you get a word in edgewise.
I think I will. Well, only
by
3.
the way,
It's
hold on.
easier.
I have a prop.
Whoa.
So as I mentioned, it's hockey season.
Uh-huh.
These are skates. These are Graf skates. By the way, Graf, I don't think they make these skates anymore. These are great. Look, we got a close-up.
These are yours?
No, they're not mine. This is my son Timmy's skates.
Oh, okay.
Timmy plays hockey, which I love. I love hockey, as you know.
Uh-huh.
I need to get his skates sharpened for him.
Oh.
Because there's a place out by us, but he no longer lives that. So I'm bringing his. It's like, remember in the Grinch? Remember when in the Grinch, little Cindy Lou Who comes and sees him ripping a tree off?
Yeah.
And what he tells her is, I'm bringing it back to my shop.
Yeah.
To fix. I'm going to fix it up there and bring it back here.
Uh-huh.
Do you remember that scene?
Yes,
It's adorable.
And there's a little round ornament that falls off and rolls
that's
over to her.
And that's what what she hears. They're like, ting. It's very.
That's probably my favorite Christmas movie.
Is it a movie?
Yeah.
Special.
The Grinch Who Stole Christmas?
Yeah. I don't know if it's a movie. I guess it's
a movie. I have it on DVD.
Yeah, but I think to be a movie, there has to be a certain duration. And I don't know if it fits that criteria.
I think it's long enough. Oh, come on.
But I do the message of that is what gets me every time. At the end, when those cats, I mean, all their shit was gone, man. They didn't have a crumb for their mouse.
Well, the mouse did find a really tiny crumb.
And then the Grinch came with his little Grinch.
Oh, that's right. He did in his
it.
little. Yeah.
Not too small even for a mouse.
Yeah.
And then the Grinch, he took everything.
Yeah.
He just left wire. I mean, he's a bad dude, but you can understand that's nature nurture as well. We'll get into it.
Yeah.
But even with that, they all went to town square, man. Didn't matter. They're still singing. They're still happy. Christmas had come. And that's exactly that to me. So you watch that shit and then you watch a Charlie Brown Christmas where Linus, he basically tells you what's going on.
Yeah.
Like all the pomp and circumstance. It's all bullshit. Because I'm telling you, you're going to go to Home Depot like this weekend. No. It's not this weekend because it's Mother's Day. Don't forget your mother. My mother passed away, so I'm off the hook. I mean, that's really, that's pretty bad, isn't it?
You've got a wife who's a mother.
Right. Yes. Next weekend, I'm just telling you, you're going to start seeing Christmas shit like sort of sprinkled around.
Yeah.
That's an effing problem. That speaks to all the ills of this society.
It's a consumer-led economy.
I've enjoyed this.
We consume all of the Christmas
I've enjoyed
things.
this a great deal. Maybe we'll be back again. I don't know. They'll take us off air.
Can we get fired from this? Is that
no,
a thing?
It's our rodeo. We'll see you later.